right, this is the second part of session 4. It's on module 9, which is intercorporate investments. And the comic strip is, I guess you lost me, Hank, at the point where we jump to light speed, travel back in time, and undo the stupid merger that's causing all of our current problems. I know this is a comic, but many people feel that mergers are done hastily or without really the proper forethought. So intercorporate investments has various types, but they all have the same idea. It's one corporation making investments in another. They could be very small, such as just a market play for perhaps some investment return, or it could be something very strategic, a merger with a large competitor, for example. We look at 3 learning objectives here. The first are called passive investments, and these are where the company exerts minimal influence over the investee. The second are equity investments, where it's kind of in the middle. They have enough to get the attention of the investee, but not necessarily have legal or effective control. And finally, the third learning objective are consolidations, where the company owns 50% or more of the investee and can absolutely exert control over that company. And the chart on the bottom here represents a flow chart as we think through how the accounting would work. So the first demarcation point is level of control. If there's no control, then it depends on how much ownership percent there is, whether it is passive in nature or an equity method accounting procedure. And the bottom is control always leads to consolidation, where you include the results of the subsidiary with your own results. Let's look a little bit more closely at the level of control to differentiate between the passive and the equity method. First, if it's from 0 to 20%, that's deemed passive with little or no control, and that is the simplest of all methods, and we'll look at that accounting method. It's simply fair value accounting. The second is significant influence, and this is between 20% and 50%, where you probably will get your phone call returned if you called at being a 20% owner in a company. However, you cannot dictate the decisions because you don't have voting control. Finally, control is where you have 50% or greater, and those require consolidation. And notice you consolidate even if you own just barely over 50% or you own 100% of the company. It doesn't matter. They both fall under consolidation because in the eyes of FASB, you dictate the results of the operation. So the consolidated financial reports should show 100% of revenues, 100% of expense, regardless of whether you own 51% or 100% of the subsidiary. There's some complications on how the accounting works, but that's the general gist of it. This table represents the accounting treatment for the different levels. First, on the left, you see little or no influence, and these are passive. The accounting uses, as I mentioned, the fair value method. What fair value means is at the valuation event, typically the year end, we will express the ownership value at fair value. We'll show you how we determine that in a moment. The balance sheet then is affected because it may go up or down from the historical cost. That's why there is typically a fair amount of adjustments to the balance sheet for passive investments. On the income statement side, when we receive a dividend, we will record that as dividend income. When we have capital gains and losses from the sale of the stock, we will recognize that as gains and losses on the income statement. And if there is a fair value change, we will show that as an unrealized gain or loss on the portfolio. If there's a sale, there would be capital gain and loss, and so those are the treatments for passive. On the cash flow side, there is dividend and sales proceeds that would benefit cash flow, and purchases are recorded in investing. Remember that investing in marketable securities is not an operating item, nor is it a financing activity. It is considered an investing activity. Makes sense. Investing in stock is an investing activity. The second category is significant influence, and here we use the equity method. This is probably the method that causes the most consternation in students. And here we look at it from the standpoint of, I put money into a company and I'm going to record things as if I were mirroring that company inside mine. And we'll show you the mechanics of equity method in this particular presentation. The dividends would not be shown in the income statement. It would be shown as a reduction of our investment in the company. And when the investee reports income, we will take our pro rata share of the income, take that into our income statement, and modify our investment account. And the sale would, as usual, any sale of an asset generates a capital gain or loss as it would in an equity method investment as well. And the treatment for cash flow is very similar to what we saw for passive. Any dividends we receive would be a part of the cash flow from the investing activities, and also the purchases is seen as a cash outflow from the investing activities. And finally, control, where you consolidate, which means we combine all the balance sheets and income statements of the parent and its controlled subsidiaries. And the income statement reflects all the revenue and all the expense to outside entities, as do the balance sheet. And we'll show examples of how we do consolidations later in this presentation. The cash flows, they're combined. The activities of the subsidiary are considered just side by side with the activities of the parent company. We're going to show some illustration of how we do this using the financial effects template. We'll look at an example where Alphabet buys 1,000 shares of Juniper common stock at $20 a share. All right, so here on the left side, we show that Alphabet buys 1,000 shares and it's in cash. So it's negative cash, negative 1,000 times the price per share of 20. So we will spend $20,000 for this investment. Marketable securities will go up by that same amount. It goes up 20,000. So this should be pretty straightforward. We had cash go out, that's a negative, and we had investments go up, and that's positive. The dollar amount is the shares times the price per share. Second transaction is that it sells 400 of those 1,000 shares at $23 per share. Now this one's a little tricky because what we need to do is recognize that we have now gotten rid of 400 shares from our marketable securities. So we say, what was the basis of that stock? It was $20 right above it. So we have to subtract the 400 shares times not the 23, but 20, which is the value of each share at the time of the sale. So we reduce it by 8,000 and we got money. So that's a plus 400 shares times 23 a share. So now we see there's a difference. We got 9,200 and the cost of that to us was 8,000. So there's a difference of a plus $1,200. That difference of $1,200 represents a gain on sale. It will show up as a non-operating item and it will be gain on sale of securities. And the dollar amount is the difference, which is 1,200. Now on this side we have a plus 1,200 equals on this side a plus 1,200. That's good. That's a realized gain. And finally, at year end, the value of the stock was $25 per share. The holding value of the shares was the 20. Our original cost here is 20. We got rid of some, but the stock that remains is at $20 a share. We have 1,000 minus 400 or 600 shares, and those shares are now at $25 a share, and we gained $5. So here what we will recognize is that there's a plus in the value, and I'll do it longhand. There's $25 to the current value minus 20 is our book value at that moment, times, and I'll again do it in detail. We started with 1,000 shares and we sold 400. And so those are the components. So there's an increase in value of $3,000. Is that a cash item? No, it's what we call a paper gain. Is it realized? No, it's unrealized, but it is nonetheless recognized in the income statement because our value of that stock has gone up by $3,000. Here in the income statement, we will show an unrealized gain on marketable securities. And that dollar amount is $3,000. One way to test it is, what is our subtotal? Right now, if I ran a subtotal of these accounts, we see it's 15,000. We should be able to just do a little side calculation, which is we had 600 shares left, and the price per share is $25, and that's 15,000. Right? So that's just a test. So that's what we've done. We've shown when we acquire stock, that's passive. That's a simple entry, increasing the investment account. When we sell it, we realize a gain or loss depending on the relative price of the book value versus the sales price. And then we show this year-end valuation. And we used to call these mark to market, which means at the end of the year, we reset the prices for the stocks in the portfolio to market. Here we did a mark-to-market reflecting that this position in Juniper is now worth $15,000, which reflects the year-end price of $25 a share times the 600 shares we own. So that's the passive investment. And when we look at GAAP reporting for passive, there's a few points here, is that we have had a change. And in 2018, we changed it from having some discretion between the classification of what is passive to no classification. They're all passive. And what this means is we must attempt to do a fair value estimate for the value of the shares. So the easy case, these are called level 1, is where the stock is actively traded. So we simply get a quote from Yahoo Finance or Wall Street Journal and use that. Level 2 is where we use market prices for the active markets that are similar to the securities that we own. And then we derive a value to the security. It's not precise because it's not our security, but it's deemed to be close enough. And level 3, if we don't have either the conditions of 1 or 2, we need to value to the extent we can, even though there's no market activity and no market valuation. So we do our best estimate available for this level 3. What would happen if we're not in 2018 rules and we're in 2017 rules? So here we look at the same year-end valuation where the stock price went to 25, and let's assume that it's the available for sale securities and look at how that adjustment happen. So this transaction, or this recorded item, I'll put in yellow because that's the one that will change. The new position will be that we would have still the mark-to-market, so that's still the 3,000. So that stays the same. But instead of having it on the income statement, it would be an adjustment to AOCI, Accumulated Other Comprehensive Income. So we're still in balance. 3,000 still equals 3,000. But notice it bypassed the income statement. And this was one of the criticisms of the AFS, is that companies could bypass the recording of gains and losses, albeit unrealized gains and losses, and it's not in the income statement, and it went straight to shareholders' equity, which most people don't read. Now we have all of the transactions, whether they're realized or not, all flowing through the income statement. Well, this describes in a little more detail the pre-2018 rules. They were 2 categories. The first is trading, which means we're buying and selling actively, and that's similar to what the rule is today. And these AFS securities are available for sale. It's where management has the intention to hold them. Now, if there's a good price, they'll sell it, but there's no long-term commitment, but there's no idea that we are going to be active in selling and buying stocks. So this was a fairly common position taken by companies. Again, no longer valid after 2018. So now we're going to look at non-marketable equity securities. These are where we have private companies where there's no available stock. As we mentioned, we need to find a way to report them at fair values. And so we need to get to level 3. And so now what we want to do is we have the option of taking our cost and doing a plus minus adjustment based on the changes that occurred since we made the investment. Again, this is a very tenuous method of valuation because particularly in small private companies, the value can gyrate pretty dramatically based on the progress of the company and the competitive atmosphere. These are required by GAAP. People do their best efforts, but this is one of those very tenuous notions that are in financial statements. How do we do disclosures related to investments? And here's Alphabet's disclosure, and they have extensive investments, and you'll see cash of $7 billion. And then they have level 1 securities of $27 billion. These are readily marketable securities and fairly active. And level 2 are these semi-traded securities, but still we can find valuation equivalents, and that's $38 billion for a total of $73 billion in adjusted costs as of the end of the year. So substantial amounts of money on Google's or Alphabet's balance sheet. The bond investments are different. So we have stocks and we have bonds, and you know that stocks are equity positions and bonds are debt positions. Here we have 3 classifications. We have available for sale, which are like mark-to-market. We have trading, which is mark-to-market, and we have held to maturity. The held to maturity is a different treatment, and these are where we make no adjustments for mark-to-market, and we keep it at historical cost only adjusted by any discount or premium that existed at the time we bought the bond. And we'll cover the notion of a premium or discount when we get to the bond chapter in this book. But the idea is that if it's held to maturity, let's say it's a $1,000 bond, during the period of our holding, it may gyrate up and down, above and below 1,000, but at the end of the life of the bond, it would be worth $1,000. So the held to maturity reflects that it's the intention of management to hold it till it's mature, which at that point, it'll be paid back at face value. And that's why we don't bother with the ups and downs of bond valuation. We just stay with the historical cost as adjusted for the premium or discount.